Good morning. Well, at least this morning where I am. Hope you're having a great day, whatever time of day it is where you are and when you're watching this video. I wanted to just provide you a brief piece of information about something that I have found is very helpful to folks, particularly just after coming out of tax time. I'm a little more alert to it, and so I wanted to share with you. Now, this is going to be for people that are over 70 and a half years of age. So this is for the older crowd, so to speak. The issue, however, is not something that should be lost on younger people. Because as you are accumulating money toward a time when you might be able to slow down in the amount of work you do, maybe retire, whatever your objective is there, you'll want to know about this. Now, it's a long way off, and of course the tax laws can change, but right now you can be a hero to your parents or grandparents, if some of them are over 70 and a half years of age, by letting them know about this little known piece of information. So what I'm speaking of is a Qualified Charitable Distribution, or as they're commonly referred to, is a QCD. Now, many of you probably are aware of what are called required minimum distributions, and these are things that are required of people that are 70 and a half or older when they have a traditional IRA type account. They are required to take a certain amount out each year based on the value of the account at the end of the previous year and their age that they will turn in the current year. That percentage increases each year you age, and so it's potential that you're going to be taking out larger amounts of money each year as you go. What a qualified charitable distribution does is this. If you are in the habit of making contributions to charitable organizations and causes, and I would encourage you to be involved in that, very much so, the ability exists under the tax law as it stands now, and as it has stood for a good decade or more, to be able to take that required minimum distribution that you have to take from your IRA each year, and instead of you having it sent to you, and then you use that money along with other monies you may have to make charitable contributions, you instead have the custodian of your IRA direct the funds to a charitable organization or multiple organizations. You might have several that you want to contribute money to out of your required amount that has to be distributed. Well, by doing that, what you're doing is you are having that money go directly to the organization and not come through your taxable income, which is the normal situation for required minimum distribution. It is taxable to you in the year that you receive it. Under a QCD, it is not. It's not included in your income, but it is also not a deduction on your itemized deductions for your tax return. Now, some people might say, well, that's a bummer. I'd like to have that amount as a deduction. Under the new tax law that took effect last year in 2018, the standard deduction was doubled for the most part. So if you're single and you're filing as a person who is over 65, so 70 and a half would be over 65, your standard deduction amount is in excess of $13,000. Actually, it's $13,300. If you're married, you get to double that amount if both of you are 65 or older, and you would be at $26,600 of a standard deduction. What that means is if you don't have expenses of mortgage interest, which many people at 70 and a half do not have a mortgage anymore, if you don't have enough charitable contributions, if you don't have enough income tax expenses or real estate tax expenses, when you add all those up, if they don't exceed that $13,300 or $26,600, then you're not going to itemize deductions, and you're not going to need to have those charitable contribution deductions. So this is a way to actually reduce your taxable income because you're not receiving your required minimum distribution as income. You're taking it as a qualified charitable deduction, or distribution, I should say. So you increase the amount that you're getting benefit for by taking the standard deduction if you're not able to itemize, and being able to reduce your income by not including that amount from the required minimum distribution in your total income. It's a great deal. How do you do it? Well, you simply tell your custodian, my church, this organization that I like and support, I'd like to send this amount of money, X dollars, to them. If it's your required minimum distribution amount or less, then it goes as a qualified distribution. There are a few things you need to be sure to tell your tax preparer at the end of the year when you're doing this, because the forms that come out, called 1099-R forms, do not specify that you did this. So you need to let them know that you made this contribution by way of your required minimum distribution going directly to the organization through a QCD. A little bit of information there for you. Tell your grandparents, tell your parents if they're over 70 and a half. If you're over 70 and a half, feel free to give me a call. I'll be glad to get into more detail with you as to how to do it and help you out with it. Been great talking to you. Have a good week. Be sure to check out the podcast at www.spcinvesting.com/podcast and have a great week. Bye.